The Federal Reserve made a big announcement recently, one that has significant implications for the economy. They're cutting their benchmark interest rate again, marking another step in their ongoing efforts to manage economic growth. This time, it's a 0.25% decrease, a move that many analysts had anticipated. That brings the target range for the federal funds rate to 4.25% to 4.5%, a significant adjustment. This is the third time in a row that the Fed has decided to lower rates, reflecting their ongoing strategy. First, they cut rates by 0.5% in September, a bold move to stimulate the economy. Then they followed up with another 0.25% reduction in November, continuing their trend of easing monetary policy. These cuts tell us something important about the Fed's current priorities and concerns. It looks like the Fed is changing its approach, signaling a shift in their economic strategy. For a while, they were raising rates to fight inflation. Now, they're shifting gears to support growth. The focus is on keeping the economy growing, ensuring stability and fostering confidence. This is a big deal for everyone, from investors on Wall Street to families trying to buy a home, as it affects borrowing costs and financial planning. As we know, the Fed's decision to cut rates comes down to two main factors. First, inflation seems to be cooling down than before, although it is still higher than the Fed's target of 2%. Second, the Fed wants to make sure the economy keeps growing. This can lead to more jobs and economic activity. It's all about finding the right balance. The Fed aims to support growth without letting the economy overheat. They don't want to slam the brakes on the economy by raising rates too high. Doing so could stifle growth and lead to a recession. But they also don't want to let inflation run wild. Unchecked inflation can lead to a loss of confidence in the economy. For year 2025, Fed signals more caution. Core PCE projection, which is a sign of inflation, is projected to be up to 2.5% by end of the year 2025. This will remain higher than Fed's 2% target. They're pumping the brakes on future reductions. Right now, they're only planning for 2 more cuts in 2025. That's a total of 0.5% for the year. Think back to September. Back then, they were talking about 4 rate cuts, adding up to a full 1% decrease. So what's changed? Overall, it seems that the Fed is feeling a bit more optimistic about the economy. They've actually increased their GDP growth forecast for 2025 to 2.5%. This suggests they're not as worried about a slowdown and don't need to be as aggressive with rate cuts. When looking at the market reaction to the Fed's announcement, stock prices took a dip, reflecting the uncertainty and anxiety among investors. It seems investors were hoping for even more rate cuts, expecting a more aggressive approach from the Fed. But remember, the market reacts to a myriad of factors, often in unpredictable ways. It doesn't always react the way we expect, and this time was no different. For an average borrower, the implications are still uncertain. However, the fact that the Fed is planning fewer cuts in the future might make some people think twice before taking on new debt. This uncertainty can lead to more cautious financial decisions. While lower rates are beneficial, the long-term outlook remains uncertain. While the Fed's projections for higher GDP is reassuring, the projection for core PCE to remain stubborn at 2.5% is concerning. Adding to the equation are softening labor markets, foreign policies, tariffs, and more. Overall, it's a bit of a mixed bag. As we are still looking at how the markets are responding, hopefully things will stabilize soon. Let us know in the comments section what your take on this topic is. Please hit the like button and subscribe if you liked the video. Thank you.